Hi there, this is a quick podcast. I'm going to look at the absolute basics of depreciation. So it's either intended as a real basic introduction to depreciation for courses where they don't do depreciation in a great deal of detail in the early days, or maybe on a course where they can get introduced to the topic early on and then more detail is going to be done further on in the course. The easiest way to think about depreciation is think about a car. If you buy a car, you're going to lose a lot of money in the early years. And I came up with this information from an American website, but they reckon that a car loses about 11% of its value the moment you drive it away. And it's going to lose somewhere between 15 and 25% of its value for each of the first 5 years. And on average, a new car is worth 37% of what you paid for it. So basically what that's saying is that you're going to lose, if you spent £10,000 on a car, you're going to lose £6,300 in the initial 5 years. So what we can see, if you look up here at this little optic here, okay, you can see that the value of the car is declining in every year. And fortunately, because of the method I'm going to show you now, it looks nice and straight, and we're going to do something called the straight line method, where it's the same amount of depreciation every year. Okay, here we've got a very simple income statement and statement of financial position with a trial balance. And what it's got in it, it's got a motor vehicle at cost, and the cost we're saying was worth £20,000 or dollars, and we're saying it's already got £5,000 or dollars of depreciation in. So what we're going to do first of all, we're going to have a quick look at something called the book value or the net book value. So at the start of the year and when the trial balance was drawn off, the motor vehicle had a cost of £20,000, but we'd already depreciated it or reduced its value by £5,000, and therefore we're saying that this vehicle is going to be worth £15,000 at the start of the year. During the year, and where we need to look down here is additional information on the trial balance, but during the year we're told that the vehicle is going to get depreciated at 25%. And you'll see one of two things in there. You may hear it called the straight line method, or they may indeed say it's going to be depreciated on cost. It means the same thing either way around if you've got a percentage in the straight line method. And what that means is that what we need to do is to find 25% of 20,000, and that's going to be the additional depreciation that's going to be added in for this year. So 20,000. I'm going to multiply that by 25%, and it's not hard to do. That one's going to be 5,000 extra depreciation for the year. So my total depreciation now at the end of the year is going to be the 5,000 had at the start of the year. I'm going to add on to that 5,000 that we've calculated for this year. So my total depreciation now is 10,000, and my net book value, and the net book value doesn't really change. Okay, the key formula for this is cost, take away, and the term is accumulated depreciation, and that means all the depreciation from all of the years. So now we're going to do 20,000, take 10,000. Okay, and that now tells me that we've got a net book value or a book value on this motor vehicle now that's only 10,000. Right, what we're going to do with this and how is it going to help us to fill in our income statement? Well, first of all, we've got our depreciation for the year, and the expense bit is the extra depreciation for the year. What we're going to do with that, we're going to reduce the profits of the business by that 5,000 because we know that this business is also going to have an expense of using up the motor vehicle or whatever other asset they've got. And what we've seen when I've done that, just watch it again, the profit was 25,000, but it's now gone down to 20,000. Next thing we need to do is to see what we're going to do in the balance sheet. And what we've already established is that this cost of 20,000 that the motor vehicle cost us, that's no longer true because the motor vehicle is now 2 years old. So if I put a figure in here for my accumulated depreciation, and remember, that's what I've calculated for this year, plus the depreciation that was already accounted for. So the two together is 10,000. And hopefully now you're going to see the net book value change to 10,000. Looking down here, okay, other figures haven't changed. So at the top we've got all of our assets. Our total assets are worth 33,000. What I couldn't do before, but I can do now, is I can put in the profit figure for the year. Because I didn't know that until I got the depreciation charged. So put that in. We take away the drawings. This bottom bit of the statement of financial position does catch people out sometimes. Okay, but we need to do profit, less drawings, and then that gives us our closing capital. And what you can see from that is that our two figures, our total assets and our capital and liabilities added together, are now equal. Okay, what I've done for you, I've done you a couple of examples to do. It's very much doing what we've already done. Got a template there, so that should make life a little bit easier for you. And you need to, and then what you can do is compare your answers to the answers to the two questions that I've provided. So any questions, obviously ask me. Otherwise, good luck and hope you enjoy listening.